Life insurance is bought by one person, but its real purpose is usually for the people left behind. If income, childcare, debt, or family stability depends on someone, their death can create a financial gap. Life insurance is designed to help fill that gap. At the basic level, life insurance is a contract. The policyholder pays premiums, and the insurer promises to pay a death benefit to named beneficiaries if the insured person dies while the policy is active and the claim meets the policy terms. Death benefit can make the surface story look simpler than the real situation. The death benefit is the amount paid to beneficiaries. Families may use it for mortgage payments, rent, school fees, childcare, funeral costs, debt repayment, or living expenses while they adjust. Term coverage is often the detail that separates a quick reaction from a wiser response. Term life insurance covers a specific period, such as 10, 20, or 30 years. It is often used when financial responsibilities are highest, such as raising children or paying a mortgage. Permanent coverage shapes what should be checked next. Permanent life insurance is designed to last longer, often for the insured person's lifetime if premiums and policy terms are maintained. It may include a cash value component, which makes it more complex and usually more expensive. Coverage around responsibilities turns the idea into something practical rather than only theoretical. The main question is not which type sounds impressive. The question is what risk needs to be covered. A young family depending on one income may need large protection during working years more than a complicated lifelong product. Underwriting questions deserves attention before the choice becomes harder to reverse. Premiums depend on factors such as age, health, coverage amount, policy type, smoking status, occupation, hobbies, and sometimes family medical history. The insurer prices the policy based on the chance of paying a claim. Beneficiary choices can quietly move the cost from the present moment into the future. Underwriting is the process insurers use to evaluate risk. It may include health questions, medical records, exams, or simplified checks depending on the policy. Honest answers matter because misrepresentation can create claim problems later. Stay-at-home parent value helps explain why the obvious answer may not be the best answer. Beneficiary choices are important. The beneficiary is the person or entity who receives the money. People should update beneficiaries after marriage, divorce, birth of children, or major family changes. Debt after death gives the situation its real-world weight. Life insurance is not only about replacing salary. A stay-at-home parent may provide childcare, household management, transport, and emotional stability. Replacing those services can cost money even if no paycheck disappears. Too little coverage is worth checking when the first explanation feels too neat. Debt also matters. If a family would struggle with a mortgage, business loan, education debt, or shared obligations after a death, the coverage amount should consider those liabilities. Policy exclusions can decide whether the problem stays small or grows into a pattern. A common mistake is buying too little coverage because the monthly premium feels comfortable. Another mistake is buying too much complex coverage without understanding what the family actually needs. Claim documents keeps the analysis tied to behavior, money, timing, risk, or trust. Policy exclusions and waiting periods should be read carefully. Some policies have rules around suicide, fraud, contestability periods, dangerous activities, or specific conditions. These terms can affect whether and how a claim is paid. Employer coverage limits belongs in the decision because it changes what action would help. The claim process usually requires a death certificate, claim form, policy details, and beneficiary identification. If the policy is active and the claim is valid, the insurer reviews the documents and pays according to the policy. Cash value complexity becomes more reliable when it appears more than once. Life insurance through an employer can be useful, but it may not be enough. Employer coverage is often limited and may end when the job ends. Personal coverage can provide more control. Coverage amount calculation should be checked before accepting the most comfortable explanation. Cash value policies need extra care. Loans, withdrawals, fees, surrender charges, and reduced death benefits can change the policy. People should understand the product before treating it as savings or investment. Major life events needs to be connected with the actual consequence. The right amount of coverage depends on income, debts, dependents, future expenses, existing savings, and how long support would be needed. A simple calculation is better than guessing from emotion. Funeral and living costs keeps the topic grounded in daily life. Life insurance should be reviewed after major life events. A new child, bigger mortgage, business partnership, divorce, or aging parent can change the need. A policy that made sense 5 years ago may no longer fit. Family stability can be found in behavior, documents, timing, or repeated choices. Life insurance matters because grief is already heavy. The goal is not to remove emotional loss. No policy can do that. The goal is to prevent emotional loss from becoming immediate financial collapse. Honest application answers makes the issue easier to name in plain words. The useful takeaway is to buy life insurance around responsibilities, not fear. Identify who depends on you, what money would be needed, how long the need would last, and whether the policy terms actually match that risk. It also gives the family time to make decisions without turning every immediate bill into an emergency. Life insurance is easiest to understand by asking who would be financially hurt if the insured person died. A parent with young children, a spouse sharing a mortgage, or a business partner with obligations may have a clear need. A person with no dependents may need less coverage or a different plan. One practical mistake is buying coverage based only on a salesperson's number or a round figure that sounds impressive. The better approach is to list the actual financial gaps the family would face. How many years of income would need replacing? Which debts would remain? Which expenses would shrink, and which would grow? Those questions make the coverage decision less emotional and more grounded. The amount of coverage should connect to real obligations. Funeral costs, mortgage balance, school expenses, income replacement, and outstanding loans are different needs. A random large number may sound safe, but a calculated number is usually more useful. Beneficiaries matter too. The policy should clearly state who receives the money, and that choice should be updated after major life changes such as marriage, divorce, children, or business changes. A good policy can still create confusion if the people listed on it no longer match the person's real responsibilities. Term and permanent policies solve different problems. Term insurance focuses on protection for a set period, often when children are young or debt is high. Permanent insurance may include lifelong coverage and other features, but it usually costs more and needs closer review. A final detail is review. Coverage that made sense when a child was born may need updating after a mortgage is paid, a business is sold, or savings increase. Life insurance should follow real responsibilities, not stay frozen around an old version of the family. Life insurance is not really about death as an abstract fear. It is about preventing one loss from becoming several losses at once. Grief, debt, unpaid bills, and forced decisions under pressure.